Good afternoon, ladies and gentlemen, and welcome to the SERICA Energy PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Mitch Flegg. Good afternoon, sir.
Good afternoon. Thank you. Thanks everyone for joining. Appreciate your time. I think you all know what we're speaking about today. On the 20th of December, we announced that we're buying Tailwind, and yesterday we issued the circular on the proposed allotment of the new shares, and associated with that, we put out a presentation which I'm going to go through here this afternoon. So I'll try and go through this relatively quickly. There's a lot of detail in here, but I'll go through this fairly quickly. I've then got quite a number of pre-submitted questions, and we'll go through those questions and the answers to them, and then hopefully we'll have time to pick up on questions that I can see are already coming in through the Q&A. And as we said earlier, if we can't get through all of the questions, we'll provide a written summary of where we are. So to start off with the rationale for this deal, I mean, it's been portrayed in some quarters as a complex deal, but I think you can kind of strip it back to the fact that these are some really good assets, and there is a really good business case at the center of this deal, and the assets that we're talking about are delivering fantastic performance now, and provide us with excellent short-term growth potential, and projects to get after. The key issue here is that we're introducing a new production hub to SERICA. At the moment, SERICA, 80%-ish of our production goes through the Bruce platform, which has been performing really well for us and continues to perform well, and we'll have some numbers on that shortly. But we've always wanted to have more diversity in our portfolio, and having an additional hub alongside Bruce, we feel will give us far more risk mitigation and security. It also balances our mix between gas and oil, which in the current climate, the current taxation climate, and the current volatility in gas prices in particular, we feel gives us protects us from some of the risks that are out there in the industry. It increases our production and our reserves significantly. So, our 2023 production will be up by somewhere in the 50 to 80% range. Again, we'll come back and talk about that. It adds a huge amount of reserves to the portfolio. So just on the 2P case, and again, we'll talk about 2P and 2C, but on the 2P case, on the last available CPR, this will add something like 2/3 to our production, so that's 67%, and that's before we take into account the good work that's been done during 2022, which we believe will add even more 2P reserves. It works for shareholders from year one. It will be a 20% increase in reserves per share, and something like a 50% increase over the next 3 years in projected cash flow per share. Again, we'll look at some of those numbers in more detail. The financial strength of the company will be enhanced. Obviously we will have more cash generation, more cash incoming to the company, but we will still retain the position as a net cash company, and so we will still retain our firepower for future M&A, for actually executing the short-term growth projects that we see, and we'll be able to continue to return cash to shareholders. And I think finally, probably in that financial strength part, one of the benefits from this is that both of the portfolios, the SERICA portfolio and the Tailwind portfolio that we're acquiring, are characterized by the fact that they actually have very low decommissioning obligations. There's a lot of similarities between what SERICA and Tailwind have done in the last few years. We've kind of both built substantial organizations in buying assets from majors. So we bought assets from BP and Total. Tailwind bought assets from Shell and Exxon and others. By leaving the majority of the decommissioning liabilities with the sellers, by investing in those assets and by growing those assets and adding value and extending life. So there's a lot of similarities in what we're doing, which is why we are really attracted to this portfolio. And finally, the deal brings in Mercuria as a strategic shareholder in SERICA. From the conversations we've had with Mercuria to date, we know that we share a common goal. We know that we share a similar view on the strategy of the resulting company, and we do believe that that Mercuria will enhance the skills that we already have within SERICA. So I don't think there'll be anything on here that comes as a surprise to anyone. There's a map there. I hope you can see this. I must admit on my screen it's looking fairly small, but it demonstrates that that we're getting some geographical more geographical diversity in our portfolio, which takes away the risk of being a single asset company. The donut chart to the top there shows that we would expect the Bruce Hub to contribute something like 50% of our production, Triton area 35%. I actually hope it's going to be slightly more than that, and then 15% coming from the other areas. But as the bottom plot shows, we will have a balanced gas and oil portfolio. I think we'll still be slightly on the gassy side of that equation, but the important thing is that the oil assets in a combined portfolio do have a very good carbon intensity level, and so the combined portfolio will remain below the UK average in terms of carbon intensity. So a few slides of graphs now. I apologise if this becomes a little bit dull, but we'll try and whip through these fairly quickly. The first chart on the left-hand side here showing that the 2P reserves that we're acquiring as part of this deal. Now this is as of the last competent persons report, and that unfortunately is a year out of date. But the 2P reserves at that stage were around 42 million barrels. But what we're thinking is more important is the 2P plus the 2C resources, i.e. the resources that we know that are there, but we still have to access, are in excess of 70 million barrels of oil equivalent. It is largely oil, but we're still talking in barrels of oil equivalent throughout this. So what will this do to our production in the middle plot here? Well, in 2022, SERICA was sitting at just over 26,000 BOE per day was the production level. We expect in 2023 that will go up to between 40 and 47,000 BOE per day, increasing slightly in 24 and slightly further in 25. We believe also that the combined entity will have a competitive operating cost level. Our expectation for SERICA alone would be that we would be just over $18 per BOE next year. Now, there's no getting away from the fact that we're in an inflationary cycle. We see that in throughout the industry. I think the SERICA operating cost for this year will be of order of $16-17 per BOE. We think they'll be closer to 18 next year. But with the combined entity, we still expect the operating costs to be significantly below $20 per barrel. So I think the competitiveness of the combined company will still be good. If we look at what the production is going to do, there's a series of plots here which are just each before the transaction and after the transaction. And everything is in a unit per share, or sometimes per 1,000 shares. And obviously, in the right hand of each case there's more shares in circulation than the left hand. So what we see that this does is the net production per share at the moment is around 32 to 36. Well, that's per 1,000 shares. Sorry, so it's around 32 to 36 BOE per 1,000 shares. That will increase by something like 23% in the first year. the number of reserves increases by something like 20% per share in the first year. The cash flow increases by 14% per share in the first year, and the earnings per share increase by just over 14% as well. So on each of those metrics in the first year, this is accretive. If we then go on to look at some of these measures over a slightly longer period, that increase is sustained and to a certain extent increased. So the production per share goes up more in that first 3-year period from 2023 to 2025, and the cash flow per share over that period is increased by something like 50%. So on every metric, this works in 1 year and it works over the first 3-year period. So what does this do to us as a company? It will move SERICA into the top 10 UK CS producers. Will be the 3rd largest listed independent. So there are a number of, a couple of non-listed companies ahead of us and a couple of majors. But it will still provide a company that has significant net cash and a company that has low decommissioning liabilities. So we're not just chasing scale for scale's sake, but we do believe that the company that we create through this mechanism will be better placed for the next phase of growth. So this is not about putting these two companies together and saying that that's it, job done. This is about creating the springboard for the next step in the evolution of the company. This is about creating a company that is better positioned to do further M&A work and to further grow this portfolio. So that's the background to it. That's what we're trying to do. How are we doing it? Well, the transaction is structured such that we are issuing 111 million new shares. Something like 28% of the enlarged company will be these new shares, and additionally a relatively modest cash payment of £59 million. This gives an equivalent price based on our closing share price on the day we announced. It gives an equivalent price of £367 million. And in addition, we're assuming £277 million, which was Tailwind's net debt. Again, that was at the end of November. Now that's already being paid down, and we'll come back to that point. So they're the bare bones of the mechanism. The valuation was effected through a valuation of each company's producing fields, taking into account the balance sheets of each company, the cash in our case, the debt in Tailwind's case, and the relevant tax positions. The deal always included the impact of the energy profits levy, so we have fully incorporated that into the thinking, but we haven't included the synergies that may be achieved, particularly the tax synergies, the overheads and G&A synergies that may be achieved. So we think there are prizes still to be won as we go forward from those synergies. There are a number of completion conditions that I won't bother going through at this stage, but happy to come back to if people want. Where we will end up is a company where the existing SERICA shareholders hold 71.1% of the shares. The Tailwind founders will hold 3.7%, and Mercuria, our new strategic investor, will hold just over 25% of the enhanced company. We believe, as I think I've already said, that there will be very good alignment between Mercuria and SERICA with regard to future M&A and future growth and the future direction of the company. We've had some really encouraging discussions from day one with Mercuria about what we want to do going forward. We do have in place a relationship agreement it's in place, but it'll be effective on completion, under which Mercuria nominate 2 non-executive directors to our board. So they will not have any executive role in the running of the company, but there will be 2 non-executive directors. We'll talk a little more about those guys as we go on, but people that we really will welcome to the board that will, we think, make us much stronger and much more efficient and much more ready to take the next steps. There are customary lock-up and standstill restrictions that actually govern what Mercuria can do in terms of selling or indeed buying more shares. And there'll be, I know, because I've seen the pre-submitted questions, I know there are a number of questions about that, and we'll come back and we'll talk about that in more detail. There are provisions in our agreement to look at whether we can extend some of the services that Mercuria already provide to Tailwind. I must stress at this stage, there is absolutely no obligation for SERICA to take out future hedging instruments with Mercuria, for example, and there's no obligation for us to take out future marketing agreements to sell our product. But we have the option to do so, and if we can find a good deal at market prices, we will and would like to continue to work and to build our relationship with Mercuria. But we've seen a number of comments of people suggesting that that we're obliged to do all future hedging with Mercuria, and that isn't really the case. It's probably beyond the scope of the time that we have available this afternoon to talk too much about Mercuria, other than to say that they are a global trading outfit. They have interests in 25 plus countries around the world. And we believe can really help us with our future M&A, and particularly if we do get into new country entries. The fact that Mercuria have a footprint in so many areas can only be useful to us and can only help our efforts. So, excuse me. So just to talk a little bit more now about the portfolio. I'll start off with SERICA. We had a pretty good year last year. Our net production was just over 26,000 barrels of oil equivalent per day, despite the fact we had an unfortunate shutdown and an issue on our rum field back in the early part of the year. The production during 2022 was in fact 17% higher than 2021, and I think in any declining commodity industry, if you do nothing, production will go down year on year. So to have actually increased production by 17% last year, we think was an outstanding performance. And we know, and it kind of gets a little bit lost in everything we're talking about at the moment, but we believe we can continue to replace reserves and continue to increase production. We had a couple of projects last year, the light well intervention campaign, which was a real success, which we intend to do the second light well intervention campaign this year, and we think we can continue to boost production. So we have some short-term growth opportunities within our own portfolio, but probably not as many really good short-term opportunities as Tailwind have in the Tailwind portfolio. And I think the performance of this portfolio during 2022 has been outstanding. A lot has been made that the average production through the year is, I think, 11,500 BOE per day, something like that. But I think this plot really shows the story. Production was on a very slight decline in the first half of the year. Then there was a long shutdown during the summer, during which some good maintenance work was done on the Triton FPSO, and we'll come back and talk more about that. But that also enabled the tie-in of the Evelyn field, which came on production late in the second quarter, and we really saw the benefit of Evelyn and Orlando in the fourth quarter of the year, such that although the annual average was something like 11,500 BOE per day, in Q4 we were seeing from the Tailwind portfolio 19,500 BOE per day. So it was an excellent outturn for the year. We saw December was over 23,000, and at times peaking very close to 25,000. Yeah, a really strong performance throughout the year. And when you add the two portfolios together, again, you can see that trending up in particularly in the fourth quarter, such that in December we were just shy of 50,000 BOE per day from the combined portfolios. But over the fourth quarter, the average daily production was in excess of 47,000 BOE per day, which is really quite significant and quite a performance, and something that both companies should be really proud of. Against that, there's the background of commodity prices. You know, we can't ignore that the success or otherwise of our industry is linked to commodity prices. We've seen continued strong oil and gas prices throughout 2022. This, for reference, goes back to 2020, when you can see that gas prices in particular really took a bit of a hammering. So what we've seen really for the last 18 months is a continued strength in oil and gas prices. And interestingly, I think you can see in this plot that there isn't really a very strong linkage between oil and gas prices. I would argue, in fact, that when we saw the weakest gas prices in the last year, particularly through May here, and this is a monthly average, so it hides some of the daily and weekly variations that we see. But when we saw gas prices going very low in May, it was actually the time that oil prices in orange were at their strongest. I think this kind of backs up one of the points we were making earlier about having the expanded portfolio with a mix with an exposure to both oil and gas does mitigate our corporate exposure to gas price volatility. So we can expect that if we do see poor gas prices, even for a short period of time, we've got the insurance, if you like, of good oil prices, and that all leads to stability in the combined company. That leads to the ability to make shareholder returns with confidence. It leads to the ability to invest in our capital programs with confidence, knowing that we have this resilience that is provided by having both oil and gas in the portfolio. So where does that lead us? What happens going forward? The left-hand left-hand bars here are SERICA's performance in the last 3 years, and the right hand shows where we expect the combined range to be. So, as I've said, I think previously, we expect in 2023 that the combined production will be between 40 and 47,000 BOE per day. In 2024, it'll be between 41 and 48. In 2025, between 42 and 49. These numbers actually already are slightly higher than we showed in the presentation that went out on the 20th of December, and I'll come back to why it says on here why that is. The recently drilled Gannet GE-04 well, which we've got a slide on in a couple of slides' time, has really come in way ahead of expectation, and this really is still, you know, news that is fairly hot off the presses. I mean, I think the rig was on location until late last night. I think that the rig came off location 8 or 9 o'clock yesterday evening. So, you know, we've only just been able to incorporate the findings of this, but that does give us, you know, added confidence that we're going to be able to maintain these sorts of levels through the next couple of years. Now, you will have seen that already. I said that the exit rate from 2022, so the combined entities were producing something like 49,000 or 47,000 barrels a day, I think I said, in the final quarter of last year. And so you might ask, well, why aren't we predicting that that's going to be the average for the year to come? Well, you know, obviously the Q3 last year was a period of uninterrupted production. During 2023, in both portfolios, there will be planned summer shutdowns for ongoing maintenance. That is absolutely normal. So that's why we expect to comfortably be within these minimum, maximum, or high and low ranges that we've put here. But we do feel there's the opportunity to outperform and to improve over this. The net effect of this, as I said, is that our net production per share will be increasing by something like between 10 and 30% in future years. Talk a little bit, and this slide divides people. I think we're trying to show a lot of information on this slide. And you remember at the start I talked about the fact that the 2P reserves, and so this is now just looking at the tailwind portfolio and the opportunities that are within that tailwind portfolio. At 1st of January this year, the 2P sales number was around 42 million BOE. There was some production, obviously, during 2022, which would bring that number down. The early results of the GE-04 well look like they're going to add back some reserves, and we already have 2 sanctioned projects where we've signed the rig contract and we're ready to go on the next Gannet well, the GE-05 well, and the B1Z sidetrack. So we think these will be early illustrations of turning some of the vast quantities of 2C resources into 2P reserves. And we want to continue to do that. So, you know, within the portfolio, I mean, Evelyn has just come on stream this year. There is a phase 2 for Evelyn, which will add 2P resources, we believe, or convert 2C to 2P. There is the Belinda field, which is the next cab off the rank, if you like, after Evelyn, and then there's the Mansell field, which is, you know, under study and feasibility studies at the moment, hasn't been sanctioned just yet, but we do look to bring these projects forward. And then the big prize, of course, is in this middle section here. At the moment, all of our work and all of our estimates have assumed that there will be a cessation of production or an end of field life for Triton in 2030. We believe that there is a huge prize in extending life beyond 2030. We understand technically what is needed. We know technically that the FPSO is capable of providing what we need. And there will be a number of projects which will be undertaken in the next few years to increase or extend the life of that asset in order to realize the value, significant value of 10-12 million barrels of reserves. If we did the same sort of plot here for SERICA, we would see the same effect. There is a huge prize there to extend the life of these assets beyond 2030. I talked already a little bit about Gannet GE-04. Really fantastic project. I think a testament to the really high quality subsurface work that's been carried out within Tailwind to identify the prize, to identify the feeling that the southern area of Gannet was not being swept, and that an additional well would address that, and then a testament to the good work of the operations team who've managed to drill that well, and it's come in with better than pre-drill estimates. So the reservoir quality was significantly higher than had been anticipated. The reserves or the oil in place encountered in that southern area of the field is 20 or 23% higher than had been expected, and the modelling indicates that this well on its own could start up at something like 8,000 barrels of oil a day, which is higher than the pre-drill estimate. The well has been suspended, as I said. The rig's just gone off contract, and we would expect this well to be tied in February, with first production before the end of this quarter. So I think a real good success story, and just an example of what is in this portfolio and the value that can still be brought out of this portfolio. I talked a little bit about the Triton FPSO. The FPSO has there's 8 producing fields, of which Tailwind has interests in 5, and there's been a lot of comment and a lot of questions, and we'll come back to them about the quality of that FPSO. People suggesting that it's going to have to come off of station for upgrades and whatever. There's been a lot of work done recently to verify the integrity of that piece of kit, and to determine that it is fit for purpose until at least 2030 with no dry dock or off stationing required. There's a campaign of upgrade and maintenance work. There was a big amount of work done with a walk to work program during 2022. There'll be another one during 2023. But the result is that the uptime on that FPSO is really good. It was more than 95% in 2022. So it's performing absolutely brilliantly, and we expect it to do so. As we said, there is an ongoing investment program. So we brought on Evelyn, we brought on Bittern A2 and Gannet E4. And we've got the rig now signed up for further wells to go forward. Conscious of time, a lot of questions around tax losses. We in the announcement on the 20th of December, we talked about the tax losses within the Tailwind companies. We can now update those to the end of 22. The numbers we gave previously were at the end of 21. At the end of 22, the tax losses sat at around 1.4 billion of corporation tax, 1.2 of supplementary charge, and a small amount of EPL. So that creates losses available for utilisation against future taxable profits in the region of 470 million pounds. There are some potential upward adjustments in future years, but we can use that as a current estimate of the losses available. We think, and I think we've shown, given the huge acceleration of production and the continued high prices, that we would expect those tax losses to be utilised within the next 3 years against the assets that are in the current Tailwind portfolio. We have not here assumed any synergies for accelerating the use of those. The timing of these tax losses is very difficult to predict, and it's very difficult to be accurate about, because if you're going to predict the use of tax losses, you have to predict accurately the profits that you're going to make, and that, we know, depends upon the performance of the assets, the level that we produce at. It depends upon the price that we receive for the oil and gas, and it depends upon our capital investment programs. And as I said, we want to continue to invest, but there is a material future taxable benefit available to the group. We've always been very, very conscious of our responsibility, our ESG responsibility, and I don't have time in this talk to go through all of the elements of ESG, but we feel that our S and G are absolutely first class, but I think a lot of people are more interested in the E part of it at the moment. As I said earlier, this transaction creates an entity that has a lower than UK average carbon intensity, and is really forward focused on reducing that. And from the measures we already have in place, we can see that we predict that will continue to decrease in both portfolios, and obviously therefore the combined portfolio over the next 3 years. And we know that the Triton operator already has a defined program of GHG reduction opportunities. SERICA is committed and will remain committed to the North Sea transition deal. And we have adopted the North Sea transition deal GHG reduction targets, which include a basin-wide reduction target of 50% by 2030. So we already have for SERICA a GHG emissions reduction action plan, and we look forward to working with the Triton operator to help them implement their plans. So we are not changing our standing or our ethos or our strategy. We are fully committed to that North Sea transition deal. So you'd be glad to know that I'm hitting the home straight now, and we are. I'd like to start to try and wrap things up a little bit. I think this is, we've labelled this a new growth phase for SERICA, but it's really doing many of the things that we already do. So, the first point here is that the new portfolio gives us an enhanced. It's an enhanced portfolio. It gives us more growth opportunities. It gives us more projects to get after. It gives us more opportunities to add value and extend the life and replace reserves. And it gives us the benefit to the access to two teams who have both been doing this for a number of years. So although I call this a new growth phase, it is actually both companies and both sets of people carrying on what they've demonstrated they can do very well. and that is to take advantage of those opportunities, whether that's deals or projects. We've got a bigger portfolio to work on. We've got the second point here is the increased firepower for organic growth. We will, as a bigger entity, have more cash flow. We still keep the firepower that we have in our portfolio at the moment. We still have a very, very strong balance sheet. We will still be a net cash company even after we take on board the relatively small level of debt that we're inheriting from Tailwind. We still will have the firepower. We will have greater lending capacity or borrowing capacity should we need it, and we do believe that we'll be in a much better position to be an industry consolidator, and to carry on with the M&A effort. And we do believe that the relationship with Mercuria will give us an even better platform and even better support to be able to do that. So again, this is not new. Both companies have been involved in M&A and deal making and have been doing that for the last several years. But we believe we'll be doing it from a position of more strength going forward. And finally, all of this gives us the opportunity for enhanced shareholder returns. I've said several times that we believe the diversity in the portfolio is hugely beneficial and will give us that stability in what we have at the moment. We will no longer be exposed to one-off shutdowns here or there. We expect this deal to be accretive at every level: reserves, production, cash flow, and earnings. And that, we believe, is a strong basis from which we can sustain and keep growing our return to shareholders. So, that, I think, brings me to pretty much to the end of the sales pitch, if you like. I mean, this is strongly recommended by the board of SERICA, and the timeline is such that, if I can make this work, the timeline is such that you've seen the first two steps on this ladder. Now, we made the announcement on the 20th of December. We published published the circular to shareholders yesterday. And that announces the general meeting to vote on the allotment of the consideration shares, which will take place at the office of Peel Hunt, our nomad and broker, on the 27th of January, which I believe is a Friday, and I believe it's at 11 a.m. It gives us, we expect probably to have fulfilled all of the conditions precedent prior to completion by mid-March, and we would expect then to be able to complete the transaction and admit the new shares to trading in late March this year. So that was fairly quick, and really because I wanted to get on to the questions. I think I'm obliged now to hand you back to our hosts. Back to me, I think.
Mitch, absolutely, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while Mitch takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Mitch, as you mentioned, we did receive a number of pre-submitted questions ahead of today's event, and as you can see there in the Q&A tab, we have received a number of questions throughout your presentation as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. Mitch, if I could just please hand back to you to respond to those questions where it's appropriate to do so. And of course, given the significant number of investors on today's call, if there are any questions that perhaps we don't get round to addressing, we'll be able to give you back all those questions submitted today to then add any additional responses where it's appropriate to do so. But perhaps now, Mitch, if I may just hand back to you. Thank you.
Thank you. I've had a quick scan through some of the questions that have been posted. I'm still looking, and there probably are over 100. And so I'm not going to. I don't think we're going to be able to answer every one. But from what I can see, the majority of the questions that are being asked have been covered by the questions that were pre-submitted. So I'm going to go through the pre-submitted questions as quickly as I can. If we have time, I'll pick up on some of the others. But I assure you that if we don't get to any that have been submitted today, we will provide a written solution. So I'll go to the pre-submitted questions, and some of them are quite aggressive, and I'll start off with one which says that the 40% share dilution to existing shareholders is unfathomable. They've supported the company as I have for several years. How is this acceptable? Where do you see the share price market cap on the day of the additional shares being added? Why is this acceptable? If directors had actually put their hands in their pockets and bought shares on the open market, second part of the question, how is the company not seeing the 25% stake handed to Mercuria is too large? It doesn't add much to that. And then the third is, how do you answer claims of empire building and that this is not in the interest of shareholders? Thanks for the question. I mean, obviously, I think that is fairly harsh. My answers to that would have been included or are included in the presentation and what we said so far. You know, we are giving or in exchange for the assets, Mercuria are receiving 25% of the shares in the large company. But the fundamental rationale is in the quality of the assets that we're exchanging for that 25% of the company. I believe that these assets have are an uncommonly good fit to the assets we have. The people are really good, and the people are a really good fit to the people that we already have. And the growth opportunities that are out there actually make this an equitable transaction. And if we can get this right, and if we can extract the value from those assets, then this is an outstanding opportunity for SERICA. So, you know, we've always said that, you know, we don't do deals for size. This is not just for it's not empire building, and I think anyone who has seen anyone in action in SERICA would know that we've actually looked at a lot of opportunities over the last couple of years, and there are lots of things that we could have done that we might have been accused of being empire building, but we're not like that. We are looking for opportunities that give us diversity, that don't mean that we expose ourselves to huge decommissioning. That is very, very important. We're looking for opportunities that do have the right environmental credentials, and this is a rare opportunity to achieve all of those things. So we think that this deal actually is de-risking for shareholders. And it gives us a great opportunity for future growth, and it brings in an ally in Mercuria who we believe are incentivized in the same way that we are to grow this company. So I think, you know, we don't look at it in terms of giving 25% of the company away. We look at it in terms of the fantastic opportunities to grow this portfolio with a really good set of assets coming in. The next question builds on that same theme, and it says basically it repeats about people putting in their hard-earned monies only to allow Mercuria to control the company. What is to stop Mercuria to taking the company where it wants to go, i.e. by purchasing more shares in 18 months' time and eventually taking the company private? I mean, I don't think there's if you look at Mercuria's record in other areas where they have taken a stake in companies, I don't think there's anything to support the hypothesis that they're trying to take the company by stealth. SERICA retains a fully independent board. SERICA, as a company, you know, we have experience of having had large shareholders. We had an 18% shareholder up until something like 18 months ago, I think, who had representation on the board. So we do have experience of working with large shareholders. I don't think there's any evidence to support that hypothesis that Mercuria want to take us private. I don't believe that that we would allow that to happen. There are, you know, obviously there are in corporate law and takeover code, there are some protections against companies being taken over by stealth. So we don't have any sense that is the case. And but you could just as easily say, well, what's to stop any other company building up a stake and buying shares in the open market and taking us private? As a listed company, there is always a risk that somebody wants to build up a stake in you, but we have no reason to believe that this creates a risk that we don't understand. There is a question then again related to Mercuria. Why, with SERICA having such a strong financial position, why does it not renegotiate with Mercuria on more favourable terms, reducing the allocation of shares or fully cash? If Mercuria want in so much, they must be open to renegotiate, or is it that they want to decide what happens to the money SERICA has built up on the books? Again, I can only really stress what I said previously. The board and management are focused on taking this deal through to completion. We believe that the opportunity is what really counts here, and there is a shareholder vote to vote on the issue of new shares, and we believe that the issue of the future use of cash is I don't really understand how that can be related to this. The board is independent. Mercuria cannot dictate what the company does with its cash, and will not be able to. So, yeah, I can't see how we could believe that this is Mercuria trying to get the cash from the company. The next question, why are SERICA deciding to remain on the AIM market? And again, it comes through to say, is this something Mercuria want? We've always said that we will look at the appropriate time of moving to the main market. It wasn't considered as part of this transaction, as part of the timing. That's not something that Mercuria have insisted upon. We do talk to all our shareholders regularly about this fact, and it's fair to say that not all shareholders are as keen on immediately going to the main market. There are a number of shareholders who see benefits from remaining on AIM. I'd be happy to discuss that, but I think it's probably slightly without the scope of today's meeting. But yes, at the correct time we are. We've always said it will be appropriate. There will come a time when we're ready to go on to the main market. But at the moment, AIM works very well for us. Next question is on production guidance, and it's a long question, and I'm not going to read out all of the numbers because I think we'll tie ourselves in knots. But basically, it's asking about some of the things I talked about in the presentation here, and it says with a production guidance of 40 to 47,000 BOE per day for the combined entity, and as we've already stated, tailwind guidance of 15 to 20, it suggests that SERICA's guidance is therefore very low, and asks why the guidance on SERICA's production portfolio isn't higher. I think the guidance for SERICA, as I said, this year produced just over 26,000 BOE per day, which we think was a very good performance, and we would expect it to be in that region next year. So and obviously, with any of these fields, with any of these assets, if you do nothing to an asset, you would expect production to decline year on year. So maintaining production at its current level, particularly when that level is 17% above where it was 2 years ago and well above where it was 3 years ago, I think maintaining production at that level is a good performance. This particular questioner says, in November this year, your rate was 29,000, so why can't you keep it at that? And I think really this is just the difference between instantaneous rates and what we can average over a year. We have to do maintenance on the assets, so just because we're hitting 29 or 30,000 barrels a day in one particular month, I would never predict we're going to do that for the whole year, because I know that during a year we are going to have periods of planned and sometimes periods of unplanned shutdown. So we're comfortable with the guidance we give. I think we can beat it. I think I would love to beat it, and I think we've got a good chance of beating it. But the guidance for next year is 40 to 47,000 BOE per day. The next question. The Triton FPSO arrived in Teesside in December 1998 and was commissioned in 1999. The design life of the vessel was 20 years. That makes the vessel approximately 23 years of age beyond its design life. My questions are, have you considered how the age of the vessel will impact future production? And B, when will the Triton FPSO need to be replaced? So, I mean, the flippant answer is that most of the North Sea is beyond design life. You know, there are platforms out there that had 20, 25-year design lives that have operated for 40 years. I think the important thing is not the age of an asset, but it's how it's been maintained and how it's been preserved and looked after. As I said, we carried out a lot of due diligence on the FPSO based on work done by the operator. And we spent a lot of time. We had an external expert engineering company come in and look at this, and they have determined that the maintenance work that has been performed by Dana, the current operator, and the upgrades that have been performed in the walk to work program last year and this year do mean that there will be no need to replace that vessel before 2035. And I think, as I said earlier, the fact is that, you know, the uptime is remarkably good, and you know, 95% uptime in Q4 of last year is outstanding, and so we do not see that the FPSO is the weak link in any way in this production scheme. Question 7. Well done on a great deal. What assurance and work has been done on the estimated £470 million value of tax losses? You know, as you'd expect, we've taken the top tax advice, top legal advice on the applicability of these tax losses. We don't call that a value. The 470 is a mechanical result just of multiplying the tax losses by the rates of tax, and it doesn't take into account the timing of utilization, and it doesn't take into account the fact that the investment that both Tailwind and SERICA are doing at the moment will add more tax losses, so there should be more shelter going forward. So we've had a lot of tax advice on this, and nothing in that tax advice leads us to believe that we should doubt the ability to utilize these tax losses. People have talked about whether there is likely to be changes in the UK tax regime, and you know, I mean, I'm probably not qualified to talk about political changes or legislation changes in the future, but we can't rule that out. But what we do know is, given the really high production levels that we have, and given the continuing high commodity prices, those tax losses will be extinguished in a relatively short period of time. We said 3 years in the presentation. So I think, you know, we will concentrate on doing everything we can to utilize those tax losses as efficiently and as promptly as possible, because that is what we do. You know, we concentrate on producing as much as we can, as quickly as we can, and maximizing our profit by making sure that we achieve that production at as low a cost as absolutely possible. And you know, we haven't baked in any synergies into this transaction, but we do believe there will be synergies. We do believe that, you know, the two operating companies or the two teams from SERICA and Tailwind will be better than the sum of the parts. I mean, both companies have high points and strengths, so I'm not going to go through those now and embarrass individuals. But we believe that we will have a far better operating capability as a combined company, and we do believe that will lead to cost savings. We in SERICA have got a lot of experience, and some of you will have heard me talk previously about what we've done on Erskine, where we're the non-operating partner, and where Erskine is I think a great success story. Since we bought that asset, we've produced more reserves than we were buying, and we've still got the same amount left. And we've driven costs down there, or we've helped the operator drive costs down there, and I think we can bring some of those skills in going forward. So yeah, I think we're going to end up with an organisation that is better than the sum of the parts. Next question. Given the current market weakness, a share buyback feels like a sensible short to medium term plan alongside the acquisition. And there are a number of questions on this theme, and I must say, you know, the questions I'm reading out now, there are a number of I've just chosen the most representative question because there are a number of questions on all of these things. So I think I've said in the presentation that we think this transaction actually enhances our ability to make returns to shareholders, and we've got to be really clear on that. That's one of the reasons for doing this, is we want to take out the risks associated with being a single asset company. We want to give ourselves more stability. We will have more cash income, and so we think that just enhances our ability to make returns to shareholders. We want to continue to establish ourselves as a dividend payer. It's quite unusual for companies of our size to be independents, to be dividend payers. We've only been a dividend payer for a couple of years now, but we've established that quite well. We do intend to continue to do that, and we are able to continue to look at larger, more irregular returns to shareholders through buybacks or special dividends. So we will always consider that alongside the other investment opportunities we have. So we do have M&A opportunities. As I've said, one of the reasons for doing this is to do more M&A, but we're looking at M&A at the moment, as I know Tailwind were for in the recent past. So we're looking at other M&A opportunities in parallel to what we're announcing here at the moment. So we will make the appropriate returns to shareholders alongside the other opportunities we have for investment, whether that is through organic or inorganic means. The next question is kind of just a variation on that theme, and it says, Serica have stated its dividend policy will remain. However, it's not clear what Serica's dividend policy actually is. Could you explicitly state what the policy is? Is it X% of net profit, X% of net free cash flow? The concern is with significant debt and hedging activities tying up cash, Serica shareholders will be left guessing. So, I mean, to be clear, our dividend policy has never been related to net profit or net free cash flow. Our dividend policy has had to take into account issues like hedging activities with the cash security, but as I think everybody knows, we've managed that issue very well, such that the Serica hedging security issue has effectively gone away now, so that doesn't come into our dividend policy. Our policy has always been to maintain and hopefully have a rising dividend in terms of pence per share, and we would expect that to carry on. So the fact is, we're going to have more shares in circulation, so our distribution through dividends, I would expect to increase dramatically this year compared to last. And I'll come back to the hedging because I know that's in one of the other questions here, and we'll get to that in a moment. We're getting on a little bit to hedging already. The next question is about Mercuria conflict of interest. And it says, what formal legal documentation is in place to ensure Mercuria's role as a provider of hedging futures contracts is not to the detriment of other Serica shareholders? As a crude example, Mercuria receive 100% of profits from their hedging, but only 25% of any Serica profits. So it's in their interests to prioritize their hedging. And what's to formally legally stop Mercuria quoting excessive above market prices? Yeah, I can understand where the question is coming from, but there's nothing to stop Mercuria quoting excessive above market prices, but there's everything to stop us accepting excessive above market prices. So we're under no obligation to put future hedging contracts in place with Mercuria. We can see advantages of having a business relationship if Mercuria can provide competitive products for us, but we have an independent board, and our independent board would not allow us to enter into excessive above market contracts. So I can't see how that would occur, and I think we need to actually all be clear that we're under no obligation to enter into any such any such contracts. The next one is around hedging strategy. And it says, just when Serica was winding down its costly hedging book and about to enjoy the risk reward of market prices, this strategy appears to take us back to one of significant hedging activity. We will naturally be forced to hedge with Tailwind's significant gross debt and with Mercuria as the largest single shareholder. I'm not going to go through the rest of it. It just amplifies that point. So let's be clear. I mean, Serica's hedging policy was not excessive. We were hedging something like 20% of our or 25% of our gas, 20% of our total production. It served us really, really well through low gas prices of the early 2020s. In the last couple of years, or last year in particular, the commodity prices were such that the margin calls were difficult, but we've actually solved that. We're not putting any new gas hedges in place. We have no intention to put any new gas hedges in place. We now have the balance sheet strength that provides us the security against that. The suggestion in here is that we're going to be forced to hedge more going forward. That is not correct. There are some hedges in position that are associated with the debt position that Tailwind has. These hedges are totally in line with what would normally be expected by a reserve-based lending facility. So they're quite modest. Importantly, the hedges are on oil. Now, there has been far less volatility in oil, and so the requirement for margin calls, those of you that have been Serica investors for a long time will know that the requirement for margin calls was caused by the volatility in gas prices. Oil has nothing like the same volatility, and so we wouldn't expect to see the same margin call issues with oil hedges. So there are modest hedges in place. That is absolutely customary for an RBL. That's not going to change. And just to reiterate, we're not going to suddenly go out and change our hedging policy, and we're not obligated to use Mercuria in future. So I hope that kind of is clear. Next one, and we're dotting around a little bit now with the questions. Could you indicate what decommissioning liabilities Serica will be taking on with the Tailwind acquisition? So I won't read the rest of the question in the interest of time. The decommissioning obligations of both companies are very low. I think I've already touched on that, and that's one of the reasons that we think we're financially strong going forward. You can't really compare decommissioning liabilities between Serica and Tailwind. Basically, in the Tailwind case, all of the decommissioning liabilities were left with the sellers up to a cap, which is at a very, very high level. With Serica, it was a slightly different mechanism that we're going to pay a small deferred contribution towards the ultimate decommissioning costs at the time of decommissioning. I think what I do know is that on a discounted post-tax basis, the Tailwind decommissioning liabilities are less than £1 per BOE. And as I said earlier, we're buying roughly 40 million BOE. So it's that I hope gives you a feeling for where the numbers are. I think I said at the start that I wasn't going to dodge any questions, but there is one I'm going to dodge. I'll tell you about the question. I'll tell you why I'm dodging it. And it starts off. It's about admin synergies, and it unfortunately talks a lot about the salaries of people within Tailwind, and I really think it would be totally wrong of me to talk about people's salaries. But it does give me an opportunity to talk about what we want to do. I mean, we want all of the people in Tailwind to come across and work for Serica. We are offering all Tailwind employees and the founders positions within Serica, and we're excited to bring those guys on board because, as I said already, they will add a lot to our capabilities. The Tailwind team, it's a small team. There's less than 20 employees and a few good long-term contractors that support those guys, and it's a well-skilled and highly experienced team. We're going to bring those guys on. They will come into SERICA initially on their existing terms and conditions during the first year on board. Our aim will be to normalise their terms and conditions with those of our existing staff. We've got some experience of doing this previously. We did a deal with BP when we brought 100 BP people into our organisation, and we successfully managed to normalise the two packages. And you know, we're really excited about doing that going forward. And I think that's one of the big benefits this gives. So yeah, but I don't want to go into individual salaries because I think that would just be unfair of me. I realise that I've gone over time already, and I've got more questions that I want to get through. So I hope you can bear with me, and I hope the organisers aren't going to cut us off or anything. But I think it's important we carry on. The next one, yeah, touches on some of the issues that we talked about already, and it says the deal seems structured much more favourably towards Mercuria. If they're going to be this great strategic partner, could it not be structured where they get rewarded as we see the benefits they are going to give us, i.e., when the share price hits certain milestones? Dilution at this stage greatly undervalues SERICA when the share price is near 6-month lows. Why wasn't a 6 or 12-month average share price used? Right, I've got to go back to the fundamentals of the deal to answer that. You know, the process of negotiating the terms were based on the underlying value of the assets of both companies, and so you know, we do believe, and I've tried to spend a lot of time indicating that we think the value of the assets that we're buying is exceptional, and the unlocked value in there is even greater. So I wouldn't characterize this deal as being favorable to Mercuria, and if I did, then I wouldn't be recommending it. The nature of this is largely that it's effectively, you can think of it as a share swap, and it means that the risks and rewards are being shared between us and Mercuria. So Mercuria are coming in as a shareholder in SERICA. They're not being paid cash for this. They're not taking any cash off the table. They live and die as we do. Well, in this deal, they live and die by the success of the organisation going forward. So they are just as incentivized for us to succeed. And I really do believe, from all the conversations we've had, and I know the guys that are coming in to sit on our board, I really do believe that their skills will help us and they will benefit as we benefit. So yeah, I'm afraid I don't, and I can't agree that this is structured favourably towards Mercuria. The next one is financial again. And it goes, given Tailwind's last known cash position, net production, 19,500 barrels a day, and net debt, £277 million, one can extrapolate revenue for the 90-day period from announcement to completion in the region of £122 million. I can't confirm or deny those numbers, but they're not unreasonable. Therefore, how much debt are Tailwind expected to pay off prior to completion, and how much cash will be withdrawn from Tailwind in the form of dividends or other benefits to either the founders or Mercuria prior to completion? So it follows, how much debt, cash are SERICA actually forecasting to finally come across onto our balance sheet? So I think what this questioner is driving at is that, yeah, as I've been saying, this is a really profitable portfolio. It will generate considerable cash in the short term. Then this questioner is going on to say how much of that will be withdrawn in dividends and go to Tailwind and Mercuria. And the answer is nothing, none. I mean, the structure of this transaction is what is commonly called a locked box arrangement. So what that means is that since we signed the SPA, that there is no ability for Tailwind to take cash out of the entity, other than for the normal course of business. So there is no mechanism for Tailwind to pay itself a dividend, or to pay Mercuria a dividend. What is in the company at the time of the SPA is in that lockbox. And whatever else comes in during the period between signing the SPA on the 20th of December and completion in March, yeah, I mean, what that stays in the lockbox. So, you know, I've not yet put an estimate on what the net debt level will be at that time, but we've already seen it's decreasing. So there was a level of debt repayments at the end of December. So yeah, anything that comes out of the company now will be to repay debt rather than to go into the pockets of the tailwind founders or shareholders. So yeah, I mean, I think we take. I think if I'm understanding the question correctly, I think that particular questioner thought that we were, yeah, that money was going to leak out of this, but there is no ability for leakage going forward. I think that really gets me through the majority of the questions that have been asked. The rest are variations on a theme. There is I've been trying to look at themes that are coming through on the Q&A, and honestly there are hundreds. I can see that there's a couple of questions here and a couple of things that I haven't picked up on. Someone has, I won't name names, but I can see names. Someone says firms such as Harbour Energy are looking outside the UK. What makes the UK so attractive for Serica? And I probably haven't picked up on that. It's a good reminder. Thank you. We are looking outside the UK. We continue to look outside the UK, and we will do. And you know, having had that conversation with Mercuria, I know that Mercuria are aligned with us on that ambition. So I know that both ourselves and Mercuria do like the North Sea. We do like the UK CS. We do have, you know, good experience here. We have good relationships with the regulator, with the supply chain, as do Tailwind, and we think we can capitalize on that. But we are alongside this looking at things overseas, and we will continue to do so. I don't think we're going to be quite as vociferous as Harbour have been, and shout about it quite as much as they have, but we do have ambitions to do more. As I keep on saying, and you'll be getting bored of me by now, I think this was a really, really unusual opportunity to get some assets that were really complementary to our existing portfolio to really cement our place and our ability in the UK North Sea. And so this stood clearly as an opportunity that stood up against the things that we are looking at overseas, and we've only quite recently started looking overseas. I think having the backing of Mercuria will help us a lot on that, because Mercuria has this footprint in a number of countries, and will probably be able, or say that they will be able to bring opportunities to us from the fact that they are in the oil and gas business in a number of countries, but also will be able to assist us with relationships and startups in new countries if we decide to go that way. So I think that is to answer that question, that is something that we are looking at and will continue to look at. And ultimately, I think, you know, we haven't really touched on it here, but you know, we're fundamentally an oil and gas company, but I think eventually we will look, and again, I know that Mercuria are in the same place, that eventually we will look to broadening into, you know, wider energy projects and transition projects as we go forward. So as we're looking at now, we've established this base position, I think we will be better positioned to be able to consider other opportunities. I'm not sure we're immediately going to rush into doing you know, wind or solar, but we will gradually look at whether we can use the skills that we've got to expand the portfolio. There are a couple of questions I've seen in here about North Egg, and we have, as you know, the egg well TD'd in December, and made a yeah, it was a disappointing result. The objective sands that we were looking for were underdeveloped, or possibly not even there. We did, however, find some sands at a deeper horizon than we had expected that were hydrocarbon bearing. Looked like good quality sands, good quality hydrocarbon, and the fact that they were deeper than we've seen water in adjacent wells, which, you know, in our model, theoretically, we shouldn't have been able to have found hydrocarbon that deep, means that we are having to, completely remap and reevaluate our model of not just of that prospect, but of South Egg, which is adjacent to it, and the whole area. So we're actually going back to basics, to first principles, getting out the old seismic, possibly reprocessing the original seismic, certainly reinterpreting everything, to see if we can design a sidetrack to go back to and re-enter the well, to sidetrack it. So we have now suspended that well, and we will be evaluating whether it's worth going back to drill a sidetrack from that well. It's one of those things that, particularly with the benefit of the investment allowances under the Energy Profits Levy, you know, that may impact the economics of that, and we may, there's a chance we will want to go back and re-enter and sidetrack that well. But it's not going to be a short process to do that processing work and reinterpretation. We were talking to the guys this morning. I think it's a several-month project still to get to that situation. So Egg is not forgotten about, but it's we're not going to see any activity in the short term. Just going through here, I think most of the other questions are around things that we've talked about. Will there be any changes in the leadership of SERICA? At the moment, as we said, no. Things stay exactly the same. There's questions about tax losses, which we've answered. I will, as I say, there's probably 100 questions here. We're going to have to go through them in detail. There's a couple of questions on here about, have we looked at partnering with firms such as XYZ and doing certain things with this company, and have we looked at investing in, you know that I just can't comment on that. I feel like one of these football managers who's asked to comment on someone else's players in the transfer market. I can't do that, but I can assure you that every one that is mentioned on here we have looked at. We are still active in M&A. We are looking at opportunities, whether they are asset purchases or partnering with people in new projects, particularly development projects. We're looking at lots of opportunities, but I'm not going to comment on any individual ones. So I think at that stage I'm done.
Mitch, thank you very much indeed for addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so, and we'll publish all those responses out on the Investor Meet Company platform. But Mitch, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, thank you. I'm probably going to sound like a stuck record here. We started off looking at this transaction from the point of view of the assets. The more we looked at the opportunity, the more we realised that this, these assets are a fantastic fit to the assets that we already have in the company. Probably haven't mentioned it, but I actually think having that diversity in the portfolio adds value to what we've got already. Because I think there was, the market was appreciated the risk that we have in our existing portfolio. So I think this adds value to the portfolio. It is accretive at reserves, production, at earnings per share, and at cash levels. It does still allow us to maintain our very, very strong financial power. It enables us to maintain our balance sheet. It enables us to maintain our environmental credentials, and it doesn't mean that we're picking up huge decommissioning liabilities. It's not empire building, it is adding value to an existing portfolio. I think it's being done at an appropriate price. I believe Mercuria will be a really supportive and helpful shareholder, and we thoroughly recommend this deal. So I'm always happy to take on any questions that people have. I think anyone who has ever emailed me has received a reply. And I want to keep that up. So feel free to send in questions. Feel free to send in criticism if you want. I mean, we're big enough to take it. And we do believe this is a good deal. So we want to answer the questions. I appreciate the feedback, and it's good to get the questions, because it helps me understand the bits where if we're not getting the message across properly. It helps me to understand that. So that's it. I've had enough of your afternoon. So thank you very much for your time.
Mitch, that's great, and thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SERICA Energy PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.